Good afternoon, everybody. Welcome to Quest Trust Company's Tuesday Powerplay. I am Kurt Power, one of the IRA specialists at Quest Trust. I'm also the business development manager. And today we have a great guest, one of my favorite people that I've been privileged to meet in the industry, John Maness, the chairman of the board of StoreSuite. He's going to teach you everything you need to know about how self-storage has historically been the most recession-resistant and resilient investment. And when we're talking about this, it's very relevant because of all the hysteria in the market. You want to be doing investments that are good in good times, great in bad times. So you're in for a treat today. If you haven't heard John speak before, get ready. It's going to be awesome. Quick disclaimer. This is Quest Trust Company education. So everything that we do is strictly for that, for your education. We don't provide any tax, legal, investment advice. We don't endorse any products, services, or investments. What this means is you need to do your own due diligence on your investments. Very, very critical. Whether you're using a self-directed IRA or your own personal funds, you got to do the due to make sure that this investment is something that you think is good for you, that's going to be a good building block or good extension in your portfolio. Always do the due, not just on the investment, but also the people that are going to be involved in that investment with you. So consult your lawyers, your CPAs, your tax advisors, that power team that you have to give you that extra confidence that the investments you're doing are wise for you. Real quick, what is a self-directed IRA? Well, in reality, a self-directed IRA is not even a type of IRA. It's just a marketing term, but it means exactly what it says. With self-direction, we are putting the control of retirement accounts back into you, the account holder's hands, to invest in things that you know best, things like real estate, things like private entities, things like promissory notes, even as something like oil and gas, mineral rights, or in today's topic, self-storage. You can invest your IRA, either tax-deferred or tax-free, into these type of investment vehicles. Gives you great diversification. It also is a good hedge against inflation, good hedge against any kind of market down cycle. So once you do the due, give us a call. We're more than happy to educate you on all the possibilities of what a self-directed IRA can do for you. At this moment, I'm going to bring on my good friend, John Maness, the chairman of the board of StoreSuite, the former CEO of Pinnacle Storage Properties. John, you and I go back a lot of years. 6-7 years ago, we met. Now look at us, two grizzled veterans, been on the road. Always a pleasure to see you. I appreciate everything you've done to help me in my career. I said it on a podcast recently. I attribute the last 5 years of my success to the experience I've had working with you. So always a treat to have you, always learn something. And yeah, tell some people about you and let's get started, man.
Well, I apologize for that. For all these years. Thanks for having me, man. It's always good to see you, talk to you, hang out with you. It has been a fun ride, hasn't it?
It has, man. It's been a pleasure watching it from the outside. And for those that don't know, I used to be the VP of Investor Relations for John. And self-storage was always something when I got into this industry 10 years ago that just clicked. It just made sense. It seemed to be something that not a lot of people were doing, but to my own naivete, I come to realize there's more self-storage properties across the United States than there are McDonald's, Starbucks, Wendy's, name the fast food chain combined. There is more self-storage. So it's literally everywhere. But I don't think sometimes people understand just how good of an investment vehicle it can be and how the cherry on top is if you use your self-directed IRA or 401k, it's even better.
Well, most people don't wake up in the morning and go, hey, I think I'm going to go do self-storage, right?
and they probably don't even say, I'm going to do it in an IRA.
Correct.
But that's why we're here, is to educate everybody about how exciting this really is. When you understand self-storage and you understand self-directed IRAs, match made in heaven potentially. But again, do your due diligence. So John, I'm going to leave right now, let you take over, but everybody please stay on after John's done. I'll have a couple quick announcements for some things dealing with Quest, for consultations with our IRA specialists, and of course the big one, the Quest Expo. So when John wraps up, we'll do Q&A, but please stay on. I have a couple quick announcements for everybody. My friend, John, take it away.
Miss me?
I'll miss you, man.
Bye. As you can tell, Kurt and I go back a while, and great friendship, great relationship. I got to tell you, I'm super proud of him. He just went and got an advanced degree. It's so cool to watch his success in this industry, and just for everybody watching, what a great guy to deal with on a regular basis. So getting into the storage piece of things, as you saw in the picture earlier, The picture shows Pinnacle Storage Properties jacket. We got new jackets for our new brand store suite. I'll go into that later of what that means in comparison to Pinnacle Storage Properties. But for now, what I want to do is I want to go into why storage is good in bad times. And it's pretty interesting. I think everybody knows where the market's at overall from any type of investment, particularly in real estate. But for storage, you'll see some similarities, but you'll see that storage is actually a bit of a differentiator based on the fact that it does have some recession resistant type of qualities to it that other asset classes don't. So let me jump into it. I'm going to give you an overview of what we're going to talk about. We're going to talk about how in 2016, 2019, construction increased. And the interesting part about that is we are a company that buys undermanaged, underenhanced, underexpanded self-storage properties. We are not a company that does development. So what we do is we buy the mom and pops, clean it up, fix it up, raise the revenue on it, which adds the value for us and our investors. And that's how we exit, is based on that increased value. Well, what happened in 2016 to 19 with the construction increasing is it actually affected the rates that you could get, the occupancy levels that you had, and so on. And it's interesting because in January of 2020, I was saying to our team internally over and over again, something has to give. Like, there's too many projects hitting the ground. For an owner operator that owns and operates storage, the construction piece of things had to slow down somehow, some way. The irony to that was in March of 2020 when the pandemic hit. That pandemic obviously slowed stuff down, but in a totally different way for storage. What ended up happening for us is we got deemed an essential business where a lot of other businesses did not. And because of that, everybody started working from home and the remote workplace started. So in asset classes like office, retail, apartments and multifamily, things like that, where the residual of money going to the worker that then paid rent, all of that started getting deferred, except in storage. The actual work from home helped our industry, and it did something to increase that demand. What it did is everybody started cleaning out the third bedroom or the fourth bedroom and making it their office. And they took all of that stuff and they put it in storage. On top of that, because husbands and wives and kids were all at home any given time, and they had downtime and became stir crazy, they started cleaning out their garage and cleaning out closets and all of those kind of things. Well, that also increased the demand of self-storage. As you all know, during that time frame, all of the taxes for imported products went up by 25%. All of the inflationary measures started to kick in back then, and the cost of construction increased, which for the owner operator was a benefit, because what that meant is as construction costs increase, construction started to decrease from 2020 to 2023. And the inflation and lower supply caused the owner operators to increase their rates. So what we saw from 2020 to 2023 was an increase in street rates and rental rates of over 30%. That was the good news. At the same time as all of that inflation happened, the Fed stepped in, as you very well know, and started to increase lending rates, which then increased the rate that you got on your mortgage, and the cost of financing increased. Not only did it increase on the, like we were paying 4 and 5% on our interest rate, it jumped to 8.5%. Not only did that increase, but the lending institutions became more and more restrictive, and it became harder to find financing. So as an example, a lot of your lenders who have been lending, I'll say from 2023 to 2024, so for the last year and a half, most of them are depository banks. So a lot of them are requiring that you put a deposit in their bank in order to get a loan for that bank. So I've seen things like if you put $1 million in their bank, they'll give you a $2 million loan. Well, if you think about that, that's about a 50% leverage mark, and that's what they're targeting. They're targeting somewhere between 50 and 60% on top of the asset. So the cost of financing increased, which, interesting enough, made it harder to find financing because they became more restrictive. And we went from a sell market to a buy market. And that's the good news for people like myself, except for one little caveat. And that one little caveat is a lot of sellers pulled their product off the market and weren't selling their storage properties. So it's been harder and harder to find a good deal that cash flows that a bank will lend you money against without putting a depository amount of money in their bank. So the good, bad, and the ugly is if and when you find them, because you do a really good job of branding yourself or marketing yourself, and you can underwrite it to a point that it's a good buy, then you're in the right market because you're in self-storage. So, all right, moving on to what we're talking about is this is the self-storage construction on the downswing on the dates that I mentioned. This is a Marcus and Millichap slide. And as you can see, this is up to the end of 2022, where you can see the peaks of development were 16, 17, 18, 19. And then they started to drop in 20. They jumped back up in between 2021 and 22 in the different markets. And since then, they've actually slowed down even more. So the good news for owner operators is there's less product hitting the market because finding financing and so on is harder to find. So if you look at it from a supply and demand standpoint for the end consumer, the supply that's in the market right now for self-storage is a pretty decent supply that is going to continue to be gobbled up from those peak times of 4 and 5 years ago, at the same time as some of these loans are coming due. So in the next couple of years, it's going to be good for owner operators to buy some of these properties and make a good return, because as the markets, the capital markets get better, and so does the economy, so will what storage brings to the table as an investment. So as you'll see, this is some of the downside of supply, which construction supply shortages favor existing operators like ourselves. Self-storage vacancy plunged during the pandemic, but the question is whether it's temporary or sticks with us. As you'll see, these are some of the vacancies that dropped. As what's happening right now is rental rates are on the retraction, and in some of my stores, some of them are down 1 or 2% in rental rates over last year, and some markets upward of 30%. It really depends on what the supply is in that market in comparison to what the demand is in that market, to what rental rates are doing and vacancies are doing. What I've noticed over the last year to year and a half in our portfolio alone is that our occupancies have stayed relatively stable and or increased a little bit, 5 to 10%, but our rental rates have decreased. So apples to apples comparison, vacancy to revenue, our vacancy plunged, meaning that we got less space to rent then. Now we've got about the same space to rent, but we're getting less dollars for those rental rates. So as you'll see, this is just color coded to what some of the vacancies are. You'll see, if you look at this closely, you'll see some of the markets that they went in and oversaturated some of those markets. For those of you in Texas, you'll see that like Houston is still a good market. San Antonio got a lot of stuff built. The other majors, Austin, Dallas, Fort Worth, are still okay. But you have cities like Nashville, Tennessee, that got bombarded with new product, like Salt Lake City, in the Bay Area of California, in Charlotte, cities like that, that in 16, 17, 18, 19, everybody saw an opportunity that they were undersupplied. So everybody went to those markets and built, where the pandemic also dictated where people moved out of and moved into. And excuse me, as you will know, a lot of the people in the Northeast, New Jersey, New York, Pennsylvania, etc., all moved to Florida for what was happening in some of the political climates. So you'll see that those are all oversaturated and the Florida market is undersaturated. You'll see people moved out of California and moved to other places like Las Vegas, Montana, places like Phoenix, Arizona. They moved out of California and started moving east, and the Northeast people started moving south. Some of the California people and Florida people, a lot of them moved to Texas. So you'll see those markets sustained their vacancy rates and actually got less vacancy, while the other ones increased their vacancy based on more supply and based on the fact that people were moving out. Rental rates back then accelerated, and now they're kind of stabilized and a little bit decreased in 2024 so far. So you'll see that in like a city like Austin, the average is $1.16, Dallas $1.05, Houston $1, San Antonio $1.12, and total United States is 133%. So what happened is people moved to Texas, which is good news for us in Texas. But what happened is so did some of the supply increase. So the rental rates went up based on the increased demand coming into the state. On top of that, in 2022, 23, 24, construction slowed down. So now across the United States, rental rates were able to be accelerated. So going back to the topic of why storage is good in bad times as well as in good times is when things like the pandemic, which is probably the most major thing that has happened to our economy in a couple hundred years, what ends up happening is in storage, people take their stuff and they store it. It increases demand, but it also increases demand based on population and based on construction. And hopefully all these slides show you that. All right, vacancy decreased and rents increased. Same thing. This just kind of recaps it on one slide. Your rents were up 6.7% year over year going into 2022, 23, 24. Right now, 24. So far, they haven't published this yet. I know my rental rates are what I would call relatively stable, but they're down in comparison to that 30% uptick for those 3 years. So we still haven't retracted back to what I would call 2016, 2017, 2018 numbers. We're only down in comparison to 2023 and 2022. So still a really good market in comparison to other rental rates in other places. All right, what are the results? Obviously, happy owners and happy investors. For a company like us, we've done 51 self-storage deals in the last 7 years. Last year, we bought 9. So in 2023, while all of this was starting to subside, we had our best buying year ever. So if that gives you an idea of where the opportunities are at, based on some of those, positioning ourselves for the next 5 years of opportunity to then stabilize your rates, stabilize your vacancy, and at the same time as you're paying down your mortgage, creating a gap of profitability to us as owners and to you individuals as investors. It's a win-win all the way around in a market that everybody else is struggling to find good investments. Storage still remains a stable investment. I don't know if you guys know this or not, but historically, storage has had about a 2% foreclosure rate overall in comparison to other asset classes that range between 8 and 30% foreclosure rates historically. That's a pretty good margin of error for something that is relatively stable, because no investment is guaranteed because it can be bought wrong. But there is the ability to have a better asset class of investment when it comes to comparing storage against things like office during the pandemic, retail during the pandemic, multifamily, or like the housing crisis of the 80s, things like that. When you get into analyzing history to see what happens for the future, storage consistently remains as one of the top investment vehicles. All right, so what I want to show you is some of the things that we do. This is our phase 1 acquisition for the New Caney property we bought. As you can see, we bought a mom and pop property, 97% occupied, gravel parking lots, a manual gate that somebody had to open every morning, and they had a waiting list of customers in a market that was growing continuously. We took that and created this. So as you can see, we did a new facade, painted it, put in a new gate system, a new flag. On top of that, we took the brown buildings, or what I call the bruised banana, and we put it into our Stores Plus colors, which is red and tan, and we made it look pretty. We also added what are called mass units, mobile access self-storage. There's a couple companies out there that make these. Janus International is this product. Boxwell also creates some that are very similar to this. And if you look closely, they sit on the ground. They're considered real property and not real estate. So they're taxed differently, but they rent as the same square footage as what you would rent the other product. And they look exactly like the other product. A little bit cheaper on cost as well. This was the office pre-purchase. This was the office post-purchase. This was the piece of land that we bought with it, 2.3 acres. We added another 48,000 square foot. We eventually bought the land right behind it where you can see those trees, and we added another 48,000 square foot to this particular property before we sold it. This is what the expansion looked like when it was all said and done. And these are some of the numbers. Our initial cost was $4.9 million with $1.4 million worth of equity in the loan. $7 million after lease up. We bought the land in the back for $800,000, $3.3 million worth of construction, working capital of $500,000, the loan $4.6. We sold the property for $13.3 million on the total raise of $1.4 million. The profit was $3.6 million. $2.1 million to investors, or a 31% internal rate of return, which is kind of like your yield, but it takes into account the time value of money. So that'll give you a general idea of what we do when we buy undermanaged, under-enhanced, under-expanded self-storage properties. This falls into all three of them and gives you an idea of what the returns to investors are. As Kurt mentioned before, past performance does not dictate future results, so you got to do your homework on each one of these projects. This is just one example of projects that we do. All right, here's our history. Pinnacle Storage Properties was founded in March of 2016. We rebranded as a fully integrated self-storage platform of January of 2024. This year, we rebranded under Store Suite. We've done 51 self-storage properties in 8 years. Our self-storage marketing company, which is Fine View Marketing, our self-storage protection plan. When you go rent a space, they require you to have insurance or a protection plan on the space. We own that company as well. We own the management company. We own the tech company for a lot of cool tech that allows you to use your Google Wallet as the way to pay, as a way to find your unit through maps, as a way to open your unit through NFCs. All of the tech is through that platform, and we own the capital company that sources all the mortgages for this. We've taken these 5 companies and merged them all together with Pinnacle Storage Properties as the 6th company, rebranded under the new pretty jackets called Store Suite. And we've created a vertically integrated self-storage platform that is asset-backed. So not only do you invest in all of these companies combined, but you also get the different properties. Or what I like to say, it's kind of like buying into a REIT as a REIT, but it's not publicly traded, it's private, and it allows you to actually own assets. So approximately $270 million in store deal volume and $15 million in the service companies combined. As you can tell, we have fun. We don't take ourselves too seriously. So if you want to join some of the fun or learn how this works or anything like that, you can reach out to us at storesuite.com. Pinnacle Storage Properties is still up and running, so you can technically contact us through that. But most importantly, if you really want to learn how to do it on your own, there's a book out there about it. I don't make any money on this book, so this isn't me self-promoting. I signed all over the rights to my ghostwriter so that she makes passive income. So if you go buy this book, you're helping the people that have helped me through the years, and this person has helped me tremendously. But this book explains exactly how to do what we do. So if you really want to learn how to do it, there's your answer. And at this point, Mr. Kurt Power, I'm going to bring your pretty face back on here, open it up, and talk about whatever the world you want to talk about.
Well, beauty is subjective, so thank you. I appreciate that. No, awesome presentation, and I would echo those sentiments. I mean, a part of why I think you wrote the book was, you know, you want to provide and give back, and also let people know that the struggle of investing doesn't have to be difficult. You know what I mean? Like it's, and I get it, and the people who know me from the storage world will still ask me, you know, I just want to go buy a property. I want to go buy a property. Would you recommend to somebody that they just go off and do it? Or would it be a little bit more intelligent to maybe invest first, partner, and kind of grow from there? What would you say to that?
So I think it really depends on what your personal goals and aspirations are. So for me, I'll use myself as an example. I could go out and buy a 100-unit property, put the money in myself, and run and operate that property. But essentially what I'm doing is buying myself a job. And let's say it's $1 million property and you do SBA, which is painful, and you have to put $150,000 down and you finance $850,000, all that kind of stuff. Will you make money at that? Absolutely you will. You will. But you're going to work your ass off to make 100 grand, 200 grand, 300 grand. So will you double your $150,000 in 3 years or 5 years and make your 150, 300,000? Sure. But you can do the same thing by being a passive investor in something, and you don't have to work your ass off to get it done. So
kind of goes back to the time value of money piece.
Yeah, it depends, but it also depends on what you want to do. Like if you're semi-retired, you're my age at 55, 60 years old, and you're coming off of a 40-year career and you just don't want to kill yourself every day, then go buy that $1 million property and run it yourself. It becomes fun, gives you something to wake up to every day, and you're going to make some money for retirement, and you're going to be semi-retired. So it really depends on what your goals and aspirations are. For me,
pays better than being the gas attendant at Costco is basically what you're saying, but it's still a job.
Yeah, but I mean, what do you want? For me, I'd rather work on a company than in a company, and for that reason, I do it a little bit differently. And then, if you look at other people that might be on here saying that's exactly what I want to do, then you got to learn skill sets of how to put together a company agreement. You got to put together your PPM or your investor packet. You got to learn those skill sets, or partner with somebody that has them. And so all of those kind of mechanics is a little bit different of a mindset, but it's more work on the front end and less work on a daily basis. So it really depends on what your goals and aspirations are. So for me, I wanted to create something really, really big. And this about me personally is I wanted to create, my first company I ever created was called Boardroom Investment Group. And the acronym was BIG, right? So I wanted to create something that was big. And so far, we've created $300 million companies and a bunch of different service companies that are different values. And that to me was more fun than going and renting a storage space and filling out a lease every day. So a little bit different kind of work, but it really depends on what your goals and aspirations are.
Right. So one of the questions we have here from Steven, great flip on the first property. Question for you. If the property is 90% occupied with a waiting list, what was the motivation for the seller to sell it to you?
He was 65 years old, ready for retirement. It was a legacy play for him. And Stephen, that's a great question. And I'm going to dog on the seller for a second, but he didn't know what we knew. So, and he didn't want to work as hard. Like we've had dinner with him and lunch with him a couple of times since we bought the property, and just a salt of the earth kind of guy. But he kept saying, we don't have the money that you have. But what he didn't realize is the value of his property was worth more than, like, he could have took that property to a bank, leveraged that money, done the expansion himself, because he already built the first phase of the property, and then added value without anything, and done exactly what we did, and created over like a 3-year time frame an additional $5 million of worth to himself, and not had to give that away to investors like we did. So his motivation was he wanted to buy a beach house down in Galveston and retire, which he did. And he wanted to kind of ride off into the sunset with, he built a warehouse style building on his personal property to put a couple cars in. And like, he didn't want to work so hard. And I mean, I can respect that at 65
Yeah.
years old. You're like, hey, so is the $5 million worth killing yourself until you're 68 years old? It probably wasn't. He was like, it's time for me to ride off into the sunset. That's what he
Kind
did.
of goes back to what you just said. It kind of depends on the person, their situation, goals, etc. So,
Yep.
yep. Follow up from Stephen on this. And what was the percentage of increase you did? Did you hike the rent to justify the rehab?
I'd have to go back and look, but typically on a property like that, they're under market by 20 or 25% on their street rates. And when you raise the street rate, you can raise the current customers' rates by 15 to 20%. You'd normally stay a little bit under that rate. So that's a typical type of property. But Stephen, I'm going to answer that question in a different way. If I was to buy that property today, I would not crank their rates by 20%. I may crank them by 5 or maybe 10. And on top of that, I would underwrite that so that my purchase price was less on the front end, knowing that if I sent 20 and 25% rent rates in today's market, a bunch of those customers are going to move out. And the demand isn't as good now as it was back then. So Stephen, if you're looking to buy something yourself now, I'd be cautious of what those aggressive rental rates are back then compared to now, because the market's changed a bit.
Good follow-up again from Stephen. As he said, he's interested. That's a good thing. When cranking rates by 20%, did you experience turnover? This is a question that I actually was going to feed, because I think it tells a good story about some of the realities of storage and lease terms, NOI, et cetera.
So it depends on the unit, the asset you're buying. I'm hesitant to say unit because everybody thinks of a 10 by 10, not the whole property. But so it depends on the asset you're buying. And the reason it depends on the asset you're buying is in a case like that, I raised revenue from $24,000 a month in that store to $45,000 a month in the existing platform while I built the other 48,000 square foot. So in about a 14-month time frame, I doubled the amount of revenue in that store by increasing rates. That's a success story. If you're going to buy 100 space property and it's 95% occupied, that means you only have 5 units vacant. If you do what is called forced vacancy by cranking everybody's rate and 20% of your customers move out, it's only 20 units. So it sounds good in percentages on a small property versus a big property. But the reality is you could probably replace those 20 units, but it's going to be a slow ride on those 20 units. You're probably only renting 4 or 5 spaces a month in that small property. It's going to take you about 6 months to replace those same 20 customers at a higher rental rate, which in turn, if you have a mortgage on that property, you want to be cautious, because when those 20 people move out, it might affect paying your mortgage. So you got to play that balance of that, particularly in buying small properties. The bigger the property, the easier it is to offset some of that mortgage cost, because $500 a month isn't going to impact your mortgage like a small mortgage has an impact on $500 a month. So I did experience turnover, but we replaced it quickly because the demand was there, and we replaced it at a lot higher rate. But that's not always the case by the size of the asset you buy or the market you buy in. And I know that because some of my properties, I bought a property last year for $11 million. We had 474 customers. They were under market by 20%. We sent aggressive rent increases to everybody. I dropped my revenue from $65,000 a month to $55,000 a month, and we haven't rebounded yet. And it's been a year. $10,000 a month hurts on your mortgage payment and your investors. So yeah, you do experience turnover, but every market's different and every economy cycle is different. Right now, the cycle's a little bit different. I'm getting the same rentals as I got last year in that store at 25% less per month than what I did last year. In April last year, I rented 22 spaces. I'm going to end the month today renting 21 spaces, but I'm renting them at 20 to 25% less than what we rented them at last year. So be careful. You can experience turnover, but every market's different.
Would you say then, with the decrease in rental revenue, that ancillary income that's a piece of the business makes it more valuable, and in some way it kind of softens the blow from the investor side?
It does.
So kind of speak to some of the ancillary drivers that you guys have.
That's a great question. So on that particular asset, we underwrote a 10-year exit. So unlike some individuals that might go into an asset on a 3 to 5 year exit or 3 to 5 year capitalization. So we knew we bought a huge expansion on that property that wasn't going to generate cash flow for 4 or 5 years. We knew that. So in theory, we paid a lot of money for that property, but we knew that because it had just had a 65,000 square foot expansion to it. So we've got 10 years to fill that up for our investors. So from that standpoint, it really depends on a lot of levers that you pull during the whole process. And one of those levers are, we knew we weren't going to cash flow on that property for 3 years. So to the investor, and they knew it too when they invested. We're in it for the long haul.
Which then speaks to the transparency, and that's and the proactive nature of communication. And one of the things that comes up a lot when we're talking about self-storage in particular, something I hear on the streets at events all the time is, for operators like you guys, why not ground up? I mean, I know the answer to that, but for anybody who's curious, why are you not doing ground up? Why are you doing value add? What's the skinny on that?
So on the ground up piece of things, I went to a presentation on a panel for the Texas Self-Storage Association here in Houston a couple months back. And it was a panel of developers, and they used to target 12% return on their investment. That moved to 10%, and now it's at 8%. And I heard the panel say that they think going into the next couple of years, it's going to be 6%. And the reason for that is the cost of capital has become more expensive. The cost of construction has become more expensive. So your return profile goes down. So, and here's why, is that capital and the construction cost makes for a larger negative cash flow on a monthly basis. So you have to put up more money on the front end to get you to stabilization on that lease up from ground up construction. Well, that more money, so let's say in years past there was $1 million you had to raise, and now you have to raise 1.5 million to get to the same lease up for the same dollar amount. That extra $500,000 dilutes your percentage, right? So that's why I don't do development, is the tail takes too long. If you're into preservation of wealth, where you're just trying to preserve your money, you're trying not to lose money. In today's market, if you're lending your money out at 8% and the market's at 8%, you're not losing any money. But if you're lending it out at 8% and you're only getting 6%, you're losing 2% on your money. That's not a good investment. I'd rather take the risk of potentially making 15 or 20% on my money as an investor by increasing the cash flow of that property over the 3, 5, 10-year time frame, and know that it cash flows day one.
Right.
I have to dump extra money in all the time. And that helps my return percentage over the long haul.
Excellent point. Last question I have, and this is something you said to me years ago, and I think it's important that people look at storage this way when they're evaluating deals. And paraphrasing, but essentially it was that self-storage is a retail business with a real estate play. Talk to people what that means, because I've heard you say it, and I've heard a couple other operators. I haven't really heard it though. It's not mainstream when storage operators are saying that. So what do you mean when you say that, and why is that important?
So how I always say it is that storage is an operating business inside of a real estate play. So as an example, let's say you want to open a restaurant, but you don't own the building. The operating business of a restaurant, or the cash flow from all of that, whatever's left over, you can make the revenue less all your expenses. Whatever's left over, you pay the building owner for the right to be in that building. So as we all know it, gross revenue, expenses, NOI, net operating income. You're paying rent to somebody else, and you're not getting any value from the real estate, from a restaurant. But let's say you own the restaurant on a certain business model, and you own the building that it was in, and the restaurant paid for the mortgage on the building. You actually pay down that as the price of the property goes up, and you use the restaurant to pay the mortgage and increase your value of that. That's what I mean by that. Is it's an operating business like you're running a restaurant that generates enough money to pay the mortgage, and now you own the piece of real estate along with it. That's what storage is.
But you take it a little bit differently because of the aesthetics. So you go to a lot of the mom and pops and the gravel driveways, the pit bull chained up on the inside, those kind of things. And I read an interview with you years ago when you talked about the gas station coffee versus.
How do you know that's exactly where I was going right now?
I mean, it's like we know each other. Like the gas station coffee that costs 99 cents, you buy the same cup of coffee at Starbucks, and you're going to pay $4.50 for it in today's world. At the time, the spreads weren't as big, but now that's the reality. But you're paying for the experience. So when we talk about that kind of aesthetic beauty,
but the other thing you're paying for is you're paying for the pretty signs inside. You're paying for the leather sofas. You're paying for the cool logo that's on the side of the cup, right?
Yep.
So that you can walk around and be cool, like I do with my jacket. But anyway, so right, that's what you're paying for.
Exactly.
Where you go into the gas station and you buy that 99-cent cup of coffee.
You're just trying to get out and get in and get out and go on with your day at that point.
It's in a plain white cup. It doesn't it doesn't have the coolness factor to it. Like you're not sitting in the gas station on a leather sofa listening to jazz music, all those things. So you're paying. That's the experience you're talking about, right? You're paying to be one of the cool kids.
So the cool kids invest with you and work with you, right?
No, what I do is I buy the mom and pop and clean it up and make it one of the cool kids.
Exactly.
I add the signs to it. I add the leather sofas. I add the wine cooler inside with the bottled water and the Doritos and the cookies and the this and the that. It's the difference of going into a rundown motel and walking into a Hilton, right? You're on more for the Hilton than you are the rundown motel.
Well, it makes me think of Mattress Mac at Gallery Furniture, what he talks about. The guy spends $10,000 a month on candy, more than that in some months. And the people ask him why. Customer stays longer.
Yeah.
They stay longer when they're having that. And the customer that stays longer is ultimately going to be the customer that eventually buys. And so it's a strategy, but exactly. Yep. And then refers their friends to it. You got to come down here. You got to see it, et cetera. Well, good stuff, John. I appreciate you, man. Like I said, guys, I'm going to have some quick announcements here, but John, how can people get a hold of you to learn more?
You can go to storesuite.com and there's a contact page there. And you can go to pinnaclestorageproperties.com. There's a contact page there. That's the easiest way to get a hold of us.
Awesome. Well, I appreciate you, man. Thank you again. Thank you for your time today. Thanks for the journey. Thanks for the lessons. I appreciate it greatly. And I'll see you down the road, my friend.
Love you, brother.
Love you. Thank you, sir.
Bye.
All right. So for those of you still on here, I want you to take advantage of the opportunity that we have with Quest. So as IRA specialists, this is our day in and day out, and we live for it. We love doing it. We love answering the questions that clients and prospective clients have, because the more that you know, the more, I think, the more confident you are in the decisions that you make. And Quest, we've been around for over 20 years, and we have the best and brightest in the industry. This is our livelihood. This is what we do every day. We know everything about IRAs inside and out. So if it's storage, if it's oil and gas, if it's single family, if it's notes, if it's any type of investment that you can think of, as long as it's not prohibited and it's not life insurance contracts, collectibles, we can guide you. We can't give you, again, the tax legal investment advice, but we can guide you on your journey and be a conduit to your success. So scan the QR code, give us a call at 855-FUN-IRAs, ask for an IRA specialist. And again, whether you invest in with StoreSuite with John, or you want to do something else, get the wheels turning. We're going to help you understand all the possibilities that exist when you control your retirement account and you invest in those things that you already know how to do. If you bought a house, you know how to buy a house. Might be a good idea to look at doing that instead of a retirement account, because it's something that you know best. So with that, guys, 50% off for the Quest Expo. So the Quest Expo is one of the largest alternative asset conferences in the United States. We're bringing it back this year, June 27th, 29th at the Irving Convention Center, Las Colinas, just outside of Dallas. The offer for this 50% off is not just for our GA tickets. This is also for VIP. This gets you access to everything at the conference for a ridiculously low price. So use the promo code EXPO50 and purchase your tickets now. Go to questtrustcompany.com, hit the resource tab, learn more about the expo, learn more about who is speaking, what topics are, so you can plan your day. Network is net worth. That's a saying that we have over and over in this industry. And why it's said over and over is because it's true. If you're looking to do things, this is where you're going to find it. You're going to find investments that you want to do. You're going to find potential partners that you want to do business with. You're going to learn from some of the brightest attorneys and CPAs in the space. So when you start thinking about deal structure and what makes a good deal and what makes it maybe a bad deal based on your own personal risk tolerance, all of that and more at the Quest Expo. So again, June 27th to 29th, Irving Convention Center, just outside of Dallas, Las Colinas. Use the promo code EXPO50 and save money on your ticket today. This is an event you don't want to miss. I can't emphasize it enough. Bluntly, the 2019 Quest Expo is the reason why I work for Quest today. It was one of the best events I'd ever been to. I got to meet a lot of the team that I work with now and got to see everybody just having fun, doing business, talking shop, talking about how they can do the investments that they've always wanted to do with the people they've always wanted to work with. So hit us up if you have any questions, 855-FUN-IRAs. If you want to talk to an IRA specialist about moving your IRA to Quest and doing your investments with your self-directed IRA with Quest Trust, give us a call if you have any questions about the expo. We are more than happy to sit and take the time and explain processes to you, explain everything that you need to know to make an educated decision that's going to benefit you in the long run. So with that, it's been a great presentation. Again, reach out to John at pinnaclestorage.com, storesuite.com, and take the time to get to know a little bit more about self-storage. And take the time as you do this journey to just ask those questions and get to know more about it to give you the confidence that you need. So I'm Kurt Power. This has been a great Powerplay Tuesday, and we will see you all next time. Thank you.